All right. Today, we're going to dig into something really interesting. It's an analysis that's basically screaming that gold might be about to make a huge move. We're going to focus on the GLD ETF. And the report we're looking at, well, it lays out a trail of clues that are pretty hard to ignore. So let's break it all down. So, this is really the million-dollar question, isn't it? Is gold about to take off? The analysis we're breaking down today argues, pretty forcefully I might add, that the answer is a big yes. Let's get into the weeds and see exactly why they're so confident. Okay, before we jump into the nitty-gritty of the charts, we gotta set the stage. I mean, why gold? Why now? Well, it's because the whole global economic picture right now is creating what this report calls a perfect storm for gold. And understanding this backdrop is absolutely key to making sense of the charts. And look at this. It's like all the stars are aligning. First, you've got inflation creeping up, which makes people think, hey, maybe I should own some gold. Then there's talk of interest rate cuts coming down the pike, which makes just sitting on cash, well, less appealing. You mix that with a shaky US dollar, all the geopolitical craziness going on, and worries about the economy slowing down, and boom, you've got the perfect recipe for a rush into gold. All right, so now that we've got that big picture context, let's zoom in, let's get to the charts, because this is where the rubber meets the road. This is where we can actually see the market psychology playing out in real time, and it's where the real meat of this analysis is. Now, the main tool they're using here is something called Elliott wave theory. And I know, it sounds super technical, maybe a little intimidating, but honestly, just think of it as a way to read the market's mood. The whole idea is that crowd psychology, all of us swinging from fear to greed and back again, creates these patterns in the price chart that repeat over and over, kind of like waves. And what I like about this analysis is that it's not just a one-off glance. They're really methodical about it. They start with the big, long-term picture on the daily chart, then they zoom into the medium term, and then right down to the super short term. It's like a detective using different lenses to examine a clue, building the case piece by piece. So when we look at that big daily chart, what they've spotted is the potential start of what's called a wave 3. Now, in the world of Elliott wave, that's the one you wait for. It's usually the strongest, most powerful part of a rally. And check this out. The price bounced hard off a major support level, and the momentum indicators, the tools that tell you how fast and strong the price is moving, they're both flashing green. It looks like this thing is just getting wound up. And a powerful move like that needs a destination, right? Well, based on how these waves typically play out, the analysis is pointing to a pretty significant target, around $415 for GLD. That's the big prize the whole structure seems to be aiming for. Okay, let's zoom in a bit closer to the 4-hour chart. And guess what? The bullish story gets even better here. You can see a clean breakout, and the price is just chugging along, making higher lows, which is exactly what you want to see in a strong uptrend. Now, there's one little yellow flag. The RSI, which is basically the market's gas gauge, is starting to run a little hot. It suggests the rally's been strong, maybe a little too strong, and it might need to pull over for a quick pit stop. And when we get down to the 30-minute chart, our most zoomed-in view, that signal isn't just a yellow flag, it's a blaring red light saying overbought. So, here's the key takeaway. The big trend looks fantastic, super bullish. But in the very short term, a little pullback, a little dip, is not just possible, it's probable. And as you're about to see, that little dip, that's the whole opportunity. So, the Elliott wave story is painting a really, really bullish picture. But you know what's even better? When you have multiple, totally different tools all telling you the same story. A smart analyst never puts all their eggs in one basket, right? So let's see if we can get some backup for this theory. And that brings us to another old-school method called Wyckoff analysis. All it really does is look at the market as a simple battle between supply and demand. And what's it saying? It's saying the exact same thing. It says that quiet, sideways action we saw before, that's over. We're now in what they call the markup phase. That's just fancy talk for buckle up, the price is heading higher. And it just keeps getting better. The moving averages are all lined up perfectly. The price is floating way above this massive support zone where tons of buyers stepped in before. And the momentum is still strong with no red flags. It's actually kind of rare to see so many different things all pointing in the same direction like this. Okay, so let's recap. We've got the big economic picture, we've got the detailed Elliott wave count, and we've got a whole pile of other evidence backing it all up. So what do we do with all this? Let's get down to the bottom line, the actual actionable trade plan. And here it is, laid out plain and simple. This is the whole game plan. There's a specific zone they're targeting for an entry. There's a clear stop loss, your I'm wrong point, tucked right under that big support level. And then you've got 2 targets to aim for, with that second one lining up almost perfectly with that $415 projection we talked about earlier. But this is the real kicker, the risk to reward. For every single dollar you'd be risking on this trade, the potential payoff is $2.50. I mean, from a numbers standpoint, that's a setup that gets your attention. That's a really attractive proposition. Hey, remember that overbought signal we saw on the short-term chart a minute ago? Well, this is exactly where that little piece of information becomes super important. The analysis basically says, don't chase it, be patient, wait for that little dip down towards the 380, 382 area. That's your optimal entry point. You know, when gold makes a big move, it's rarely a solo act. The whole sector usually comes along for the ride. So to really tie a bow on this, the report takes a quick peek outside of just GLD to see if this trend is showing up anywhere else. And sure enough, this isn't just a GLD story. The whole gold sector seems to be singing the same tune. The gold miners ETF, GDX, it's setting up in a very similar way, and even the big individual stocks like Newmont and Barrick are starting to flash their own buy signals. This really suggests we could be looking at a powerful, sector-wide move. So there you have it. You've got the big economic story providing the fuel. You've got the clear chart pattern giving you the roadmap. You've got confirmation from all these different angles. And you've got a detailed, actionable plan. I mean, the case for a big rally in gold has been laid out pretty clearly. The only question left is the one right there on your screen.
Welcome back to the Deep Dive. You sent over a fantastic stack of sources this week. I mean, charts, detailed notes, multiple indicators, all completely laser-focused on GLD, the gold ETF.
It's definitely the asset to be watching right now.
It really is. And these sources are, well, they're dense. We're looking at Elliott wave counts, volume profiles, short-term RSI signals. So our mission today is to cut through all that complexity. We're going to try and distill this whole confluence of technicals and macro fundamentals to either confirm or, deny what looks like a very powerful buy-Y setup for gold.
That's exactly right.
Wow.
And what we're seeing in GLD, it's not just a small fluctuation. I mean, the price action is at a really critical structural junction.
Okay.
So to separate the noise from the actual market structure, we have to use this multi-time frame approach you provided. The goal is to understand why. Why does the structure suggest a big move is coming?
Okay, so let's start there with the big picture, the tools you laid out. Our foundation here is built on some pretty standard, reliable indicators.
Right, the basic.
We've got the 50 and 200 simple moving averages, the volume profile or VPTR, RSI, MCD, and some clear fractals marking the swing points.
Yep, all the core components.
But the real centerpiece of your analysis, especially on the daily time frame, is the Elliott wave count. Now, this is where things get really interesting, but, also a little subjective.
Yeah.
So what's the structure telling us?
Well, the daily chart is, I think, the strongest piece of evidence we have. The price action is showing this really clear and aggressive rebound. We are now, I would argue, analytically confirming the start of what appears to be wave 3 of a new major bullish impulse.
Wave 3, the big one.
Potentially. And the key to that confidence is where the last move ended. The prior corrective phase, wave 2, it looks like it completed right near that critical support area of, $360 to $365.
And that's not just a random number.
Not at all. That zone aligns almost perfectly with the rising 50-day moving average. And that's a major non-subjective technical safety net.
Okay, hold on a second, because Elliott wave is, by its nature, subjective. So if we miscounted wave 2, where's our backup? What's the safety indicator that tells us, hey, no matter the wave count, this trend is real?
That's a crucial question. If we ignore the wave count entirely for a moment, the confirmation comes from 2 other much less subjective factors.
Okay.
First, the price successfully held that 50-day MA and then printed a really strong series of bullish candles right off that level. That's a classic sign of support holding.
I see.
And second, and this is maybe more definitive for momentum, the NQD performed a clean, very clear crossover from below the zero line.
Ah, so that crossover is the objective signal.
Exactly. That's a powerful signal that market momentum has flipped to the long side. It confirms the impulsive nature of the move, regardless of what we label the waves.
That's the structural justification we need. Okay, so if we accept this is the powerful wave 3, the one that's often the longest and most explosive, we can start looking at targets. What does Fibonacci projection tell us?
Well, we project this move by taking 1.618 times the length of wave 1. That simple calculation, it points us directly to an initial target zone of about $405 to $415.
So that's the minimum objective.
That's the minimum structural objective for this impulse, yes.
Mm.
And if we check the health of the momentum, the daily RSI is currently sitting around 63.
Which is good. It's not overbought yet.
It's ideal. Momentum is building strong, but we are not yet overbought. It leaves significant fuel in the tank for this wave 3 to really run.
Perfect. So the daily chart confirms the strategic direction, the long-term target. But we all know the devil and the best entry is always in the details of the shorter time frames.
Always.
So we need to move from that strategic vision to the tactical reality. How do the 4-hour and 30-minute charts reinforce this view? Or maybe complicate it?
Both, actually. The shorter time frames confirm the internal strength of this wave 3, but they also introduce some immediate tactical warnings.
Okay, let's start with the 4-hour.
On the 4H chart, we have really solid structural confirmation. The price broke out above a major consolidation base, specifically moving above the 50 MA in that $300 to $310 zone.
Right.
And crucially, since that breakout, the price has established a really high-quality higher low, right above $370. This confirms the internal subwave structure. It tells us the acceleration is legitimate.
That all sounds like pure strength, but, these vertical moves rarely last forever. Are there any immediate warnings we need to be aware of?
Absolutely. The 4H chart is already flashing a bit of a caution light. The RSI is up near 72.
So we're getting into short-term overbought territory.
Exactly. The larger trend is still very much intact, but that level strongly implies we should expect a minor pullback, a little wave 4 correction, potentially around that $395 to $400 area before the final push.
Okay, but what about the immediate picture?
The immediate warning is even tighter. If we zoom into the 30-minute time frame, what we've seen is just a vertical acceleration, a true intraday impulsive rally that kicked off from that $370 zone.
And this is where the analysis becomes a real-time problem for someone looking to get in. We have this confirmed target of $415, but if we're going vertical, patience is everything.
Yeah.
What's the 30-minute chart telling us?
The crucial detail on the 30-minute is the RSI spike. It's currently sitting at 86.
86, wow.
Yeah, that is definitively massively intraday overbought. I mean, that technical signal is basically shouting at you to expect an immediate, small, corrective pullback.
So the charts are telling us the structure is phenomenal, the target is clear, but do not chase the price right now.
That's a perfect summary. It's a true test of discipline for any trader, waiting for the chart to cool down a bit.
Is the volume confirming the move, at least?
It is. And that's the good news. The underlying health is undeniable. We're seeing volume increase significantly during this acceleration, which confirms genuine institutional participation. It's not just a retail frenzy.
Okay, so it's institutions pushing the price. Yeah. That validates the target.
It does.
Excellent. Now, let's make sure we're not just seeing the world through an Elliott wave lens. We need to do a cross-check. How does this align with other strategies? And more importantly, what's the fundamental why behind this?
The technical convergence here is it's exceptionally strong. From a simple moving average perspective, you have the gold standard. The 50 MA is trending sharply up, and it's well above the 200 MA. That confirms long-term trend health.
Simple but effective.
Right. And next, let's look at volume structure with the VPVR. It shows us where the market has been doing the most business. GLD has successfully broken out from a major, very dense volume node that sat between $307 and $310.
And what does clearing that volume node tell us specifically?
It confirms that a heavy accumulation base has been established and now cleared. Once price breaks decisively above a zone like that, it means the market has absorbed all that resistance. It's accelerating into a low resistance area.
And for those who follow classical analysis, you also mentioned a key alignment with Wyckoff theory.
Yes, from a Wyckoff point of view, this is crucial. The price has moved out of a very long distribution or reaccumulation range, and it's now firmly in the markup phase.
The markup phase, that's the explosive part.
That's the explosive phase where the market gets pushed higher after all that institutional accumulation. It confirms this is a structural, long-term shift, not just a quick trade. And to top it off, we confirmed no momentum divergence was detected, so there's no hidden weakness.
That structural shift, moving into the markup phase, that really is the sharpest takeaway here. So what are the real-world macro factors giving gold this powerful tailwind right now?
The fundamentals are providing the energy for this technical move. We identified 4 clear tailwinds. First, global inflation expectations. They're sticky, they're persistent, and that increases demand for gold as the classic hedge.
The classic playbook.
Second, the market is aggressively pricing in potential rate cuts for next year, probably starting in 2025. This lowers the opportunity cost of holding something like gold that doesn't have a yield.
Makes it more attractive than bonds in that environment.
Exactly. Third, and this is highly correlated, we're seeing U.S. 10-year yields cooling off and a noticeable weakening in dollar momentum. A weaker dollar makes gold cheaper for everyone else, which usually means stronger prices.
And the last one.
And finally, the safe haven narrative is absolutely intact. Ongoing geopolitical tensions, slower growth forecasts, it's all maintaining high institutional interest in GLD as a defensive asset.
Okay, so that combination, a Wyckoff markup, a clear Elliott wave structure, validated by volume, and these concrete macro tailwinds, it's the perfect argument for a sustained move.
It's very strong confluence.
So let's summarize for the final decision and the actionable details. The conclusion seems unambiguous. The BUI setup is confirmed.
Confirmed, yes. But the entry has to be tactical.
Yeah.
Based on all those technical levels, the suggested high probability entry zone would be somewhere between $382 and $386.
Okay. And the stop loss.
Given that strong structural support we talked about, the critical stop loss has to be set just below the 50-day MA. That gives us room to absorb some normal volatility. Let's call it $359.
Got it. And the targets.
Our targets, derived from the structure, are target 1 at $405, and then an extended target 2 up at $415 to $420. This setup, if you wait for the proper entry, gives you a really robust risk-reward ratio of about 1 to 2.5.
A 1 to 2.5 RR is excellent, but we have to circle back to that critical warning from the 30-minute chart, that RSI at 86. We can't just throw an order in right now.
No, absolutely not. That overbought signal makes the tactical recommendation essential, which is to wait for that anticipated pullback. A move back towards the 382 range would be an optimal, much lower risk entry point.
So you're respecting the short-term need for the market to consolidate.
Exactly. Patience here is absolutely key to managing your risk properly.
And before we wrap up, what about the assets that usually move with GLD? Should you be watching those for confirmation as well?
Absolutely. We identified 3 highly correlated opportunities that should mirror this impulse. You have GDX, which is the Gold Miners ETF, NEM, which is Newmont Corporation, and Gold D, Barrick Gold. If GLD is truly in a markup phase, these should follow, probably with even higher volatility.
Good to know.
So, to just synthesize everything, this isn't just a market fluctuation. We are witnessing a powerful convergence of Elliott Wave's impulsive structure, a confirmed technical breakout, and clear macro support from, a weakening dollar and that safe haven demand.
What's truly exciting about this, especially when you bring in the Wyckoff view, is that GLD seems to have moved from consolidation into a long-term markup phase. This suggests we're at the start of a multi-quarter trend, not just a multi-week trade.
It has that potential, yes.
So here's a final thought for you to chew on. Considering the strong institutional volume and the fact that the primary macro drivers, geopolitical instability, the flight to safety, they aren't likely to just disappear quickly. How much further could this Wyckoff markup phase extend if that fundamental support persists well into 2025? Could the true structural targets actually push far beyond that initial Fibonacci projection of $415? Really think about the durability of that underlying safe haven narrative.
That is something to ponder and potentially prepare for.
Absolutely. Until next time, keep digging into those sources.